The investment environment this year has been challenging. Asset returns from equities, corporate credit and commodities have fallen significantly as high inflation drove spending cuts. Government bond returns have also fallen on rising interest rates. We hope that the global economy can transition from the stagflationary environment into a soft landing. However, we are preparing for the prospect of a global recession led by the US and developed markets as high inflation continues to cause spending to fall and unemployment to rise eventually. The fall in US equities is already greater than other periods where a recession ultimately occurred, so we could conclude that markets are already signaling a recession ahead. And the reality is that any policy stimulus is likely to be too late to avoid a recession. But the good news is that it should help drive recoveries, which typically floats all boats and creates a wide range of investment opportunities. More importantly, we have emphasised that after managing the downside, investors should consider remaining invested because even in tough markets, there are still relative winners. For equity investors, the regions are sufficiently differentiated, which is likely to provide attractive investment opportunities. For example, China is benefiting from favourable valuations and its stimulus-driven rebound. With significant stagflationary stresses across developed markets and notwithstanding its COVID re-lockdown risks, China could potentially sustain its 2022 equity outperformance over the US and Europe into next year. If a global recession unfolds, Asia could prove to be better placed than other countries to provide more targeted policy stimulus to support growth, in part because the inflationary pressures are less acute across Asia than they are in developed markets. The investment sectors that we favour include technology, e-commerce, consumer products, healthcare, financials and renewables. We also believe that there is further scope for defensive stocks to potentially outperform relative to cyclicals, especially across developed markets. For opportunities in fixed income, conservative local Asian bond investors that typically buy and hold to maturity may start to find the relatively higher real yields on offer across some Asian markets attractive. Stagflation concerns are also motivating some investors to seek diversification with inflation-linked bonds. But for the majority of investors, nominal government bonds are an obvious asset class that is most likely to benefit from the transition away from stagflation, as yields are likely to slide with weaker growth. We maintain our less constructive bias on Asian corporate credit, but we do prefer investment grade over high yield given the greater global recession risks and the relatively stronger balance sheets of Asian investment grade firms. Lastly, we believe that the US dollar can continue to benefit from the strong terms of trade, the tight monetary policy of the Fed, and safe haven flows concerned about global recession. The US dollar may only experience pressure to depreciate if its value becomes too stretched or if safe haven demands moderate in the event that a soft landing can be achieved for the US economy.